as we move forward with alternative energy, which today is cheaper than it's ever been. The problem is the infrastructure to power the electric vehicles that automakers are planning that are making now and are planning to grow at an exponential rate their production of. That's still not in place. You can have the greatest electric car, but if you don't have enough places where you can charge them, or the trucks you build, it could be a problem. And so, but what we think is happening, we think the administration has begun to pivot and soften its viewpoint of traditional energy, which is good, and that's a big improvement. So we don't think commodities are well, we do think commodities near term have fed into the inflation that everybody worries about. We do think this will begin to be remedied as competition steps in to heal the global supply chain around a large number of commodities as well as parts and supplies. There are profits to be made in meeting demand. And that inevitably, we believe, will occur. It won't happen all at the same time, but we do believe the high levels of inflation that many countries, including our country, has experienced of late, will begin to recede as competition becomes more robust once again to the levels that we'd seen pre-pandemic. And in doing that, we think it will drive down the inflation rate. I'd also like to show you the chart that shows the yield of the 10-year Treasury all the way back to 1965. Could we have that chart? It would be page 17 of the charts I sent, if you have them. I'm hoping you've got them. Hello? There we go. Terrific. Thank you very much. If you look at this chart, you'll see that the yield of the 10-year Treasury peaked right about just a little bit before I got into this business, before 1983. And when it peaked, the Treasury yield of the 10-year Treasury was near 15%, near 16%. I think if I'm looking at this, the print isn't exactly clear there. I think around 15%. And what we saw at that point is Paul Volcker, who was then chairman of the Federal Reserve, took draconian measures against inflation. He hiked the Fed funds rate to a level that brought the economy to its knees effectively, and then it rebuilt, and it really caused a dent in inflation. Now, from that point onward, over the next 30-some years, inflation declined, and the Federal Reserve remained vigilant about inflation. At the same time, central banks around the world adapted the policies of the Fed because they saw it worked, and they became more vigilant in their own way, depending upon what the structure of their economy was. And inflation really was contained for many, many years. Now, in this process, as you can see, there have been attempts for inflation to come back, but it just has failed. And since 2007, when the emergency measures were put in by the U.S. Federal Reserve and the U.S. Treasury Department by then Secretary of the Treasury, Hank Paulson, and then Chair of the Fed, Ben Bernanke, interest rates went even lower in an emergency effort to provide enough liquidity for the economy to heal from the financial crisis. And just after we were getting done with that, and we began to see interest rates rise from 2015 to 2018, all of a sudden we ran into the pandemic a little bit after that in 2020, and we went through further declines of the Treasury yield. Where we are now, we're beginning to see the Treasury yield rise. It hit as high the other day, I think it was around 1.8%, but that still is well below the averages over the years.